Hello and welcome to this special State of the Economy show. We are analyzing the second quarter GDP numbers that are just published by the Ministry of Statistics, by the MOSPI. It's a shocker. At 5.4%, even the lowest respondent in our poll did not have a number lower than 6.3%. So, it's a good 1 percentage point lower than our lowest forecast. And if I were to tell you that the Reserve Bank began the year by expecting this quarter to have a growth of 7%, as recently as October 6th, in the previous monetary policy, the Reserve Bank maintained that we could see a 7% GDP growth in the July, August, September quarter. 5.4 is outside the realm of anyone's belief. By the time we came to the October bulletin, we could see that the Reserve Bank had come down to 6.8. On the street, a poll done by me just, 48 hours ago indicated that we would still get a 6.5% growth. We are over 1 percentage point less than what the street is prepared for. The lower numbers, agriculture is a little lower than my poll. I had expected 3.6% going by what the respondents told me, but we are getting a number of 3%. That's not so bad. It's mining that's quite a shocker. Mining numbers have come in at minus 0.1. That's a bit of a shocker. The other number is manufacturing, coming in at 2.2%. The number that I got from the Economist was as high as 4.7. So there seems to have been a very big, drop in those numbers. And the other big number that's disappointed people is financial sector. The finance sector has shown a growth of only 6.7%. The numbers that I had got were close to 8%. Finance, real estate, insurance, all that come together. Real estate had a fairly decent quarter. 8% was the expectation, but the number we are getting for finance is only 6.7. Trade, hotels, transport and communication is a very big employment-heavy sector, expected to grow at about 6%. It's delivered 6%. It's not all that bad. So it appears to be more manufacturing, financial services, agriculture itself and mining that have taken the economists by surprise. Construction has come in at 7%. That's not a bad number. I think that was about the expectation that we got as well at 7%. In fact, it's done better at 7.7%. The real problem appears to be mining and metals. Now, we could see it even in the first quarter numbers. The second quarter corporate results. Metal companies, metal and mining companies and oil and gas were the companies that showed negative EBITDA, showed the lowest growth, and therefore it's possible that the same thing is moving on into the GDP number as well. So that's the preliminary comments that I can think of. The consumption and investment numbers also are not very impressive. GDP can be looked at from the output side, that is agriculture, how much agriculture has contributed, how much manufacturing. That's the output side. It can be looked at from the expenditure side. Are you spending on investment? Are you spending on consumption? Are you spending on exports or imports? The consumption growth has only been 5.9%. That's a rather poor number. We were over 7% in the first quarter. And investment, which has been running between 7 and 12% over the past 7-8 quarters, has slumped to 5.4. Here perhaps the blame lies with the government. Government capex had not picked up in the first quarter because of elections. It was expected to pick up in the second quarter, but looks like states and center have not really got this area going. Those are the preliminaries that I can see from the numbers, but I'll defer to the experts. Joining me is a star panel, Kaushik Das, the Chief Economist, India at Deutsche Bank, Aditi Nayar, the Chief Economist, ICRA, and Sakshi Gupta, Vice President and Senior Economist at HDFC Bank join us. We will have more economists joining us in just a bit. Aditi, first thoughts, 5.4, will it require a lot of revisions to future numbers as well?
Lata, certainly this number has come in well below all of our expectations. Consensus was around 6.5%, so big downside surprise over here. And you mentioned the sectors that led to the downside. In my mind, it's actually manufacturing which has really led to this lower than expected number. Most of the others are, in the ballpark of what we had expected. Mining as well, as you said, has come in with a contraction. And the services sector as a whole has come in about 70-80 basis points below what we had penciled in. Agriculture also 50 basis points below our initial projection. So it is broad-based, but I would say that, definitely the weakness in this quarter is to a very large extent being led by manufacturing and by mining. Now, for the full year, I am still hopeful that a couple of factors are going to lead to better looking numbers in H2. Part of it is kind of a catch-up as compared to what happened in the first half of the year. So one thing which will turn around is that, with the heavy monsoon, the positive impact of that is actually going to be more visible in the agri output in the second half of the year and in the rural consumption numbers, even as urban consumption is showing further signs of unevenness. And on the government capex side, with every passing month, the asking rate to be able to meet the budget estimate is climbing higher and higher. October again with Diwali, we've not seen a great month on the government of India's capex outflow for the month of October. And the asking rate now to reach the budget estimate of 11.1 trillion it's really climbing very steeply with every passing month. So we are expecting there to be a larger miss in capex. Possibly we need to be prepared that the miss is going to be in the range of 1 trillion or thereabouts. But even with that, we'll still end up with a very high growth in capex in the second half of the year, despite this anticipated miss. So some of these factors will lead to better looking numbers in the second half.
Okay. The government fiscal numbers have also come in, and the April-October capex stands at 4.6 trillion versus 5.5 trillion year ago. So there is a 15% fall if you look at the April-October number. Of course, we need the July, August, September numbers. I'm just giving you the full 7 month which the government has just released. So clearly the government has not been able to pull up its capex in the second quarter as well. Let me go over to Sakshi. Initial observations, Sakshi, what has led to this severe disappointment?
Well, Lata, I think we were, one of the forecasters that had a conservative estimate of 6.3, but as you mentioned, this is significantly lower than that. I think, you talked about, and Aditi talked about this, sectors, and clearly, manufacturing and mining have been a problem. I think that was something that was anticipated. I think from the demand side, we have to understand that this GDP growth number shows you that in the Indian economy actually is seeing a triple whammy, right? Where you are seeing a slowdown in domestic consumption, you are seeing a slowdown in investments. A large part of that is because of the slowdown, in government capital expenditure, but also on the private side, we haven't really seen a very meaningful broad-based pickup. And third, you are also seeing headwinds from, the slowdown in global growth and trade. So your export growth was also lower in the second quarter. I think going forward, while I agree that, there's going to be some pickup and support from, the recovery in rural demand and with the government kind of ramping up, its expenditure over the next few months. But given the extent of slowdown that we are seeing in Q2, I think there is now a downside risk to, my full year projection. And I remain kind of, cautious in terms of how much we'll be able to kind of cover up to, get to a 6.8 or 6.7% growth number for the full year.
Okay, I'll come to your forecast in just a bit, but Kaushik has also joined us. Kaushik, did you pour through the numbers? Are you as shocked as the rest of us? And what are the observations?
Yeah, the last few quarters we've been shocked on the upside, and the numbers have been 8% and whatnot in FY24. So this is the first time you are getting a negative shock. I was more comfortable with my GVA number, which I had forecasted at 6.1. So it has come at 5.6. It's still lower, but the GDP obviously has come much lower. And if you look at the, obviously you have to go through the numbers in details to see discrepancy and all these other factors. And, but basically what has happened, as you, alluded to earlier, that investment has come down quite a lot compared to what we had expected. Even private consumption, is slowing down at 4%. So in the GDP side, the weakness is more than what we had anticipated. But the positive way to look at it is probably this is the bottom. And from here, October, December, January, March should look better. But obviously that will pose still a downside risk to the full year forecast that all of us have. But remember that in February end, we will get all kinds of revisions to FY24 and the first half numbers as well. So we have to see how things go. But the broad story that, I thought about 2024 when, we started forecasting last year, that growth would be slowing down in the first half because of different factors, which is probably playing out at this stage. The numbers we can, debate. Urban consumption has been slowing down because there's been a heavy lifting done by urban consumption in the last 2 years. Rural consumption is picking up, but I doubt whether it will be able to kind of offset the slowdown in urban consumption. Aditi spoke about the government, investment lagging and unlikely that it will finish the 11.1 trillion allocation. So, to some extent, there are headwinds even going forward. And FY26, we have a lot of global factors which will, impact growth. So probably we are stuck at about 6.5% growth, going forward. And that is still going to be a good number. But compared to whatever we had expected or whatever RBI had expected, particularly, number is quite lower. And then we have to think in terms of, policy support. Is there anything needed urgently, to support the economy, or this is just a 1 quarter blip, and from here we just, pull back to, 6.5 or higher, and, things should be okay from here on.
You touched the most sensitive spot, didn't you? Whether policy support is needed, and we will know shortly, maybe in a week, whether the Reserve Bank is moved to that extent. I just wanted to point out a few more numbers to three of you, since all of you have had little time to look at the numbers. Net exports actually should not have been such a drag. Exports have grown by 2.8%, second quarter over second quarter. Imports have fallen by 2.9%, almost 3%. So net exports cannot have been such a drag. The drag appears to be more from capex. 5.4 is some kind of a low, isn't it? Last quarter, it was 7.5. Before that, 6.5. Before that, 9.7, 11.6, 8.5. We don't get a low capex. I think this is the lowest capex growth in almost like 7-8 quarters. So clearly state and center are not kicking off as much in terms of capex. So just those two observations. Sakshi, you want to add? Net exports actually should have been a contributor. It's not such a drag because exports have grown, imports have fallen.
No, you're right, Lata, but I think relatively compared to where we were, last quarter or the quarter before, it would have, the support from net exports would not be, as high, right? Okay. So, and I think even going forward, we'll have to kind of wait and watch because how the export situation pans out. And with the rupee depreciation, how the net export mix kind of weighs on growth or is supported. So from that perspective, I think that you are kind of moving into a scenario where, consumption is not broad-based. Investment, both, as I said, government and private, you haven't really seen a huge traction. And now also on the external side, the support that you earlier had is perhaps slowing down.
Okay. Well, now let me get a little more futuristic than I have asked so far. Aditi, will you want to bring down, of all the numbers I got, you are in line with the Reserve Bank in terms of your expectation of the second half of the year. You are standing almost at an average of 7.3% for the second half. Do you think you have to significantly lower that?
So, Lata, if you'll just give me a minute. On the capital formation, it's actually quite strange. Both center and state capex had contracted in Q1 and have grown in Q2, but not as high as what we would have liked. Given that, the slowdown in the CF component of the GDP data seems a little incongruous. My initial reading may be wrong because I looked at the data very, very quickly. I think discrepancies has turned around from a positive to a negative or a negative to a positive. So my sense is that the breakup of GDP into the components, let's not look at the sequential trends between these two quarters. Something is amiss which will get resolved in the revised data which we will get possibly next quarter.
Now, I take your point. Discrepancies are negative both in first quarter and second quarter. It is these other numbers which I never have understood in my life. Valuables and changes in stocks. Those are the two elements that are a little big. Changes in stocks was minus 11.4. Now it has become plus 14.4. First and second quarter. That seems to have disturbed the numbers a goodish bit. But that doesn't explain from the output side. No. From the output side, clearly, mining has done badly, manufacturing has done badly, financial services has done abysmally. When did we last see financial services as low as 6%? I think that is a shocker, isn't it?
Definitely. And coming back to your original question in terms of the outlook for the second half of the year, we want to pair it a little bit, but I think some things still, I would say, when we look at the high frequencies for October and November, they do seem to be better than last quarter. There is an expectation that we will get a bump up on spending from the government in this quarter. Now, I again looked very briefly at the fiscal numbers. While the capex number for October is not impressive, there is a huge jump in revenue expenditure from the government of India in the month of October this year as compared to last year. Now, that obviously revenue expenditure doesn't have the best multiplier. We don't love to see it as a driver of growth, but in the short term, it does drive growth, right? So there are going to be some
drive consumption,
So second half numbers will still be much better than the first half numbers. For the full year, I think I'm going to now look at 6.5 to 6.7% for the full year FY25 growth projection with Q1 and Q2 where they are today. So not presuming any revisions.
Got it. Kaushik, do you think now we have to be prepared for a 6-point low decimal number? Maybe, lower than 6.5 for the full year.
Oh, but I think we can still possibly get to 6.5 because if we think about our October, December, January, March average forecast till now, it's about 6.9, which was always lower than RBI's 7.4. If you get 6.9 and October, December looking like, the growth kind of momentum has picked up after bottoming in July, September, you can still hit 6.5. But no matter how you slice or dice the data, we'll wait for revisions obviously in end February to see where it stands. But growth momentum definitely is slowing down, whichever way you look at it. We know the anecdotal evidence of urban consumption slowing down, and we are seeing that reflected in consumption data. Investment before elections, probably private investment, came to a standstill. After elections, people were probably waiting for US elections to come in, and there were too much of rainfall, so it didn't happen. Now you have a little bit of a lot of uncertainty actually what will happen in the US from next year. So investments going forward could remain low. So there's always a risk. But what I'm trying to say is that probably India can grow at 6.5% this year and next year, but this could be low. This will be lower than the potential growth rate of the economy. And that's why I keep on coming back and saying that, because fiscal consolidation will continue even next year, you probably need some monetary policy support to ensure that growth stays at 6.5. So to answer your question, in order to get 6.5 for the next, 9 to 12 months, you need monetary policy support so that it doesn't fall more than 6.5 from where we are today.
Okay. I just did the math. If you want a 6.5 for the full year, you have to get 7% in both the quarters, third and the fourth quarter. Otherwise, the arithmetic doesn't work to 7%. After this break, that big question that Kaushik is repeatedly pointing to, can we get that 7% only if the Reserve Bank obliges with a cut in December itself? That question after the break. 6.5%, which was already much lower than the Reserve Bank's expectations of around 6.8%. I've been speaking with Kaushik Das, with Aditi Nayar and with Sakshi Gupta, all three economists. Ladies and Kaushik, thank you very much for your patience. Straight away to the big question. Sakshi, do you think this number at 5.4 can move the Reserve Bank into cutting as early as December? or they have to worry about the other big number, which is their mandate, inflation at 6.2?
Well, I think not cut as early as December, because the inflation optics clearly, with the last print above 6%, perhaps moving in December is, not likely, in my opinion, by the RBI. But clearly after this growth number, I think the probability of the RBI moving in the February policy has increased quite significantly. And, I kind of agree that given how growth momentum is now panning out, we'll have to see, a lot more stimulus or support coming in from the Reserve Bank if we are to kind of maintain a 6.5–7% growth over the next, couple of quarters, both in terms of the policy rate, but also in terms of the liquidity situation. And something that I think we have to kind of now recognize, that the structure of the Indian economy is very different post the pandemic, and households are much more vulnerable to interest rate changes, given the fact that you have so much leverage consumption happening now compared to where we were, 4 or 5 years ago. So in that context, I think that there'll have to be some amount of policy support to achieve these growth numbers.
Oh, take your point. Liquidity tightening that was done for other reasons in mid of 2023 kept the liquidity tight, and that will perhaps has already come home to bite. Kaushik, I was looking at your likelihood of 6.5%, and what makes it difficult is Q3 and Q4 of last year had the highest GDP numbers, 8.6 Q3 and 7.8 Q4. A 7% growth on that looks like a tall order. So what's your best guess of the full year, and more importantly, rate cut?
Lata, first of all, February end, when these numbers come out, it will come out with a lot of revisions. So for all
Sure.
second half of FY24, if the growth number comes down, then suddenly the base may look, favorable. But that is all statistical. Yeah, I mean, and what we are seeing is that even if you get 7%, you'll get to only 6.5%. I mean, without the revision. So that's something which we need to keep in mind. Now, as far as growth and inflation is concerned, what are the numbers? We have 6.2% inflation and growth at 5.6% or 5.5%, whichever you want to take it, for July-September. RBI is still an inflation targeting central bank. So obviously it will give more importance to inflation being above the upper threshold. So I don't think, December immediately RBI would be cutting rates. But I've written this few days back that RBI should be cutting at least the CRR, at least 25 basis points, and infuse permanent liquidity, so that, the liquidity in the system improves to some extent, and you can, drive the short-term yields lower to the repo rate. And if RBI feels strongly that growth is kind of fallen too much compared to their expectation, you can possibly have an effective easing by bringing liquidity again, into the system, so that the short-term rates fall to the SDF rate without cutting the repo rate immediately. And then, decide in February whether they should be cutting rates or April. Now, the thing is, if you've seen RBI State of the Economy report, it kind of indicated that October-December nowcasting is tracking close to 7.5%. I don't know whether it will go up that high, but even if you are at 7%, then the question is whether you see July-September as a temporary slowdown, and after that you're going back to 7%. Therefore, you don't need to panic and cut rates, but you start with the liquidity transmission. So you've changed the stance to neutral. The next stage could be a CRR cut, and you bring the liquidity back to the system, and then follow through a rate cut in either February or April, depending on how urgent.
Kaushik, my apologies for cutting you because we are out of time. Aditi, sorry, only 10 seconds. What policy support?
So status quo in December, and higher likelihood of a rate cut in February, followed by April if inflation kind of falls in line with what we're hoping.
Okay, thank you very much. So none of our economists are expecting a rate cut, but really CRR cut comes on the table because of this, and also because the Reserve Bank may have to be in a liquidity squeezing mode. Every time it sells dollars to protect the rupee, what you're actually doing is pulling back rupees from the system. You're selling the dollar, taking away the rupees. So that's why, as Kaushik was pointing out, the call rate, which ought to be at 6.5 at the repo rate, has gone up to 6.7. It's gone up to the higher level of the corridor, and perhaps now CRR cut comes on the table. when the MPC meets on December 6th. It's not an MPC preserve, it's an RBI's decision. We have to see whether they use that tool. Thank you very much, Aditi, Sakshi and Kaushik, for enhancing our understanding of the GDP number. The GDP number is an unadulterated disappointment. On that note, we wrap up on the State of the Economy show. Please stay tuned in. There's lots of news and views lined up for you.